All right, let's cut right to it. We're going to talk about what really moves the markets. And here's a hint. It's not the dramatic headlines you see everywhere. We're going to look at the hard data, the stuff that proves what's real signal and what's just noise. So you see a headline like this, right? Global stocks hit all-time highs. It feels great. Everything's up, the news is celebrating, seems like a fantastic day for everyone in the market. And here's the actual number behind that big headline. The S&P 500, the big benchmark for the US market, was up 0.21%. I mean, it's not a massive jump, but hey, up is up. And that's what pushed it into record territory. Okay, but here's where it gets interesting. That little average number, it's hiding a way more dramatic story. Because for some really big companies, this very same day was, well, it was the complete opposite of a party. Yeah, minus 10.83%. This wasn't some tiny startup. This was Oracle, a huge multi-billion-dollar tech giant. Their stock didn't just dip, it plummeted. That's a brutal day for anyone holding that stock. So how is this possible? How can the overall market be hitting an all-time high while a massive company like Oracle is just in a nosedive? It feels like it makes no sense, right? But it's not a contradiction. In fact, understanding this is the absolute key to understanding how markets really work. Okay, so the whole answer comes down to one simple idea: separating the signal from the noise. So what are we talking about here? Well, think of it like this. The noise is all the stuff you see and hear. The headlines, the drama, the emotion, the chatter. It's the story. The signal, that's the stuff underneath. It's the cold, hard data, the earnings reports, the economic facts, the numbers that actually add up to what a company is worth. And here is the single most important thing to get. Markets follow the signal. They do not follow the noise. The price moves because of the data, and the headline is just the story we write about it later. All right, let's prove it. We're going to dive deep into that huge Oracle drop and see exactly how this works in the real world. So here's our company Oracle, a tech heavyweight. And on this particular day, they became the perfect example of just how disconnected one company's fate can be from the market as a whole. And here comes the noise. This is the story from the Wall Street Journal. Oracle shares tumble on AI spending worries. See? It's simple, it's dramatic, it gives you a villain, AI spending worries. Oh, and it gets better. Here's another layer of noise, this time from Bloomberg. Now it's not even about the company, it's about a person. Larry Ellison's wealth plunges $25 billion. This is pure 100% noise. It's personal, it's sensational, it's designed to get a reaction. Look, those are great stories, super compelling, but they are not what traders are reacting to. That's just the narrative. So let's ask the real question. What was the actual signal? What was the piece of data that made all those computers and traders sell? So in the world of finance, a signal is just any new piece of hard data that makes you rethink what a company is going to be worth in the future. The headline, the noise, was AI spending worries. But the signal was a new calculation. It was the concern, based on data, that their future costs were going to be higher than everyone thought. And higher costs? Well, that means lower future profits. So let's just lay it all out side by side. On one side, you have the noise, AI spending worries. In the middle, the signal, the actual data suggesting that high AI costs are going to squeeze future profits. And the market reaction, it's just simple math. The stock price gets adjusted down by almost 11% to account for that new information, cause and effect. Okay, let's zoom out now, because this isn't just an Oracle thing. This is how the entire market works. You have to remember, the market isn't one single thing. It's not one big story. The S&P 500 is just an average of 500 different companies, and every single one of those companies is putting out its own individual signal every single day. And check this out. On the exact same day that Oracle was one of the biggest losers, look who was a top winner, Royal Caribbean. They were up more than 7%. Why? Because they had their own signal. Maybe it was amazing booking numbers, who knows? The point is, the market looked at Oracle's bad news and Royal Caribbean's good news as two totally separate things. This chart really says it all, doesn't it? You've got the S&P 500 with its tiny little bump up, you've got Royal Caribbean shooting for the moon, and you've got Oracle taking a nosedive. Three completely different stories on the very same day, all because they were driven by three completely different signals. So, what's the big takeaway here? How can you actually use this idea to make sense of all the financial news out there? It's actually pretty simple. Here's a 3-step process. Step 1, see the headline and just recognize it for what it is. It's the noise. Step 2, ask yourself, okay, what's the number? What's the piece of data behind this story? Go find that signal. And finally, step 3, connect that piece of data to how the market reacted. Suddenly, the price change isn't some big mystery. It's just a logical result. It all boils down to this. Focus on cause and effect. The data is the cause, the price move is the effect. Everything else, it's just commentary. So, I'll leave you with this question. The next time you see one of those screaming, dramatic financial headlines, are you going to get swept up in the noise? Or are you going to be the one who steps back and looks for the signal?